Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to this guy, John Teixeira. Once again, we are back this week to discuss market saturation.
Market saturation.
If you guys have any questions about market saturation, there's these cool AI tools that exist that'll probably describe it to you. Or you can give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com, or just continue listening as we discuss market saturation.
All right. Are we going to do this whole podcast in movie tone?
No, I
Like
just thought
movie
it was
voice? I like it.
It was a general term, so I had to make it
Market saturation.
courage dramatics over here.
Right.
So which market are we saturating?
So market saturation could be a whole bunch of different things. What we're going to focus on today, right, is regarding our rental. We're investors, and what do we need to be worried about or thinking about regarding market saturation regarding our rentals when we're marketing them, buying them, whatever we're doing, right? When we're setting a price, all of it, right? Like how much competition do we have is what that comes down to, right?
Yeah, and I mean, some might ask simply is market saturation just an oversupply, or is it just a supply versus demand? In theory, it is more supply than demand, but when you talk about market saturation, there's also a kind of a time factor to it. It's more of a discussion of, is the market getting saturated at
Too quickly.
Yeah, is the supply increasing a lot quicker than demand? It's just like, if the towel was soaked, right? And if it was saturated, did it all come at once, or did it get there?
Well, it's like inflation. You want a healthy rate of inflation, just like you want a healthy rise in rental rates, right? And so the market supply is kind of the same thing. You want it to be at a healthy rate. Market saturation implies that it's too high. It's higher than healthy.
Yeah,
right?
it's not just an oversupply. It's
Right.
a saturation. You have too many. So why talk about that? Because there's big considerations that need to be made in saturation, because while we talk about time, market saturation could be the market getting flooded with something all at once, too many rentals on the market versus demand of tenants trying to move into them.
We went through a period prior to and during COVID where institutional buyers were snatching up hundreds of homes in our market per month. Hundreds. And making it hard for people to buy their first and second home. And that was a form of saturation in the standpoint that a lot of these homes went from being people's primary residence and were turned into rentals. So that's one way you could saturate a market.
Yeah, you could also supply constrain a different market, which is kind of what they did. So yeah, you turn the saturation in the purchase market into a saturation in the rental market, and what does that do?
You just say things I don't even know what you said.
What do you mean?
I don't even know what you said. I don't even know.
You don't know? If
No.
you buy up all the properties and turn them into rentals, how many more properties are there left for homeowners to buy?
Well, that wasn't my point. So you are creating two problems, I guess, is your point, is you're creating a lack of supply for people wanting to buy homes, but also you're also increasing the supply of rentals, which was the point I was making. But yes, you're right. You're kind of creating two problems by doing that at the same time. There's the other obvious one we've seen recently is apartments, right? I mean, we've had an enormous amount of apartments go up over the last, I don't know, I want to say 5 years, but it's really been longer than that. But it seems like in the last 5 years, they've really popped up a lot. And it's not just near, where I live, but as I drive around my market, even an hour or two away, I'm seeing that there is no piece of land that is safe, right? It seemingly everything is just popping up with multifamily housing. And when you have, let's just say, I'm going to use a number. Let's just say you add in 5 years' time 30,000 units, meaning homes for people to live in, right, that you're renting that are strictly rentals, that has a huge impact on the rental market in that city. If that rental market only has, let's say, 50 or 60,000 units right now, and you add 30 to it, you just diluted the amount of availability enormously. Then diluted, that's the wrong word. You saturated it.
Yeah.
And that's going to have a direct impact on that market, what you can sell, what you can rent for, how many applications you're going to get, what kind of applicants you're going to get.
Well,
Every part of that process.
It can trickle into the other markets, right? So like, because we're talking conceptually about market saturation. So there's market dynamics that go with this just fundamentally. So if you saturate a market, what happens? Initially, you're increasing the competition and you're likely driving down prices to some extent if demand can hold them up or whatever. But to some extent, your prices will get reduced if there's too much supply, especially in one submarket. So if you're talking about saturating the market with apartments, you would think that now they're all competing and lowering prices to compete. And now what you can get an apartment for versus what you could get maybe a 2-bedroom condo for, or a single family home that's a starter home for rent, the prices get closer and closer together.
Right.
And then now you can have, which can then lead to a saturation in the lower end single family market.
You're exactly right. And to your point, what used to happen was people would say to us, well, yeah, I want to come rent your 1,700 square foot 3-2 for $1,800 a month, because that apartment, that 2-bedroom apartment, and just raised their rent to $2,200, right? I just made those numbers up. But that was a real scenario where people were like, I'm paying more for an apartment than if I bought a little house or rented a house from you. And that's, to your point, that gap is closing. So it's not, now it's just a matter of, do you want to live in an apartment or a house, because the prices are becoming very similar.
And the market dynamics of the multifamily industry is they're going to take these discounts initially. So if they saturate a market, they're going to get things at least for lesser amounts, and then that's going to hurt the other market. So yeah, that's that. And
move-in costs, people don't consider move-in costs. That's a big part of it.
Yeah, and then you got other commodities, right, that have gone up in price. Electricity has, the consideration of what your electricity bill is a lot different than it was 5 years ago, even here in Texas. Water, ironically, I pay, why do I pay the city twice as much for water that I did 5 years ago? I don't know. Let's leave that to everybody else.
It's because they haven't built any new reservoirs. That's why. But anyways.
No, but they were dumping water to other cities for free last week because they were overflowing, So, I mean, inflation, it's forced upon you. Well, not just electricity and water, you have, gas prices have gone up. I mean, if you have propane tank on the property, there's a big consideration, right? So apartments have almost, in this changing environment we've been in, especially the last few years, with not just the utilities and the prices and the maintenance, the landscaping prices, all these things have gone up. Well, now the more conservative approach of, should I just get an apartment where the costs are more known, is becoming something that's affecting that market dynamic as well.
Because you don't have maintenance costs, right? If you rent an apartment, and it's the same price, you don't have to do landscaping. You don't have to do pest control. There's a whole bunch of things that tenants don't have to do that make it a little bit more appealing.
And it's a brand new complex, so your electricity bill can be estimated to be as efficient as it can be, right? New building standards and high efficiency stuff. So new AC unit, all that stuff. So that can be known to some extent. Even water in apartments is generally sub-metered and all that stuff. So not that we're pushing for that, but it's just a market shift. When you get this is an interesting time we've been seeing of just general market saturation that's trickling on through, right? As these things came from, like you said, a saturation in the purchase market over the last few years has trickled into these other ones, because that's the natural flow of these market dynamics. But and then you get into a point of, not everything can be saturated, right? Like mid family housing, like the 4 or 5 bedroom houses that are still somewhat affordable, seem to be the quickest moving things, the market that's not saturated, because you don't have this other market that's trickling into that. there's not people aren't building
not
4-bedroom
move-ups.
apartments. There have been a lot of townhomes being built too that match that description. So, all these things come into play. That's still single family. But.
Well, as we drive around and we see apartments and townhomes and all that stuff, there's something, I heard somebody tell me this a long time ago, probably over 10 years ago. And they said the future of real estate will be smaller and smaller lots. And that was hard to and still is to some degree, hard to wrap your brain around when you look and see how much land is still out there unoccupied around us. There is so much. There are miles and miles and miles and square miles just sprawling around us that are completely unoccupied. It's still private land though, right? But so it's hard to drive around and wrap your brain around that. But I read something just the other day about how for the first time, the price of a home, the land that it sits on, is roughly 25% of the value or the cost of that home. So the cost of buying that land is 25% of the total cost of the home, and it's never been that high, which is more of a testament to how things are just going to constrict. Lots are going to go. I know it seems like a different topic, but we were talking about apartments and multifamily, and that's kind of part of it, right? You're able to saturate more when you're able to put a whole bunch of units on a smaller piece of property. Like, how many acres does that 300 unit apartment complex sit on?
Yeah.
What, like 2 or 3?
Not that many. What a couple houses might sit on normally. So.
Yeah.
I mean, they just stack them higher, right? The sky doesn't run out of room. Unless the city tells you you've hit your limit.
That's why we have skyscrapers. That's why Manhattan exists, I guess. Everyone has to live on that Hudson River. I don't know why.
So, I mean, what are the other dynamics of market saturation? We're not even necessarily saying we're in market saturation. There's sub-pockets of it happening. There's also many parts of our market that are still undersupplied. So this is not a statement of that. It's just more of the dynamics that people don't consider, because what do you got to do if you do enter a market, or your property that you already own ends up in a market that may be a little saturated? You need to get competitive, right? And how do you do that?
There's a couple ways we do that. One, the easiest, simplest answer is price. Be competitive on price. And when I'm looking at pricing, when I'm looking at renewals or marketing a new home, I'm always taking into consideration what my competition is out there. So if I have a house on 123 Main Street and there's another one down the street at 143 Main Street, exactly like it, it's $200 less. Do I want to compete with that? Now, sometimes you might want to. Sometimes you're like, you know what? I don't want to be $200 less. I'm going to wait for that thing to go away because it's going to go away in a matter of days. But what if it doesn't? And if it doesn't, then the market just told you that house was $200 less and it's still sitting there. Then you're definitely going to be sitting there. It's just basic economics. And that's kind of step one.
And then you have the affordability factor that is played into these markets more recently than it has in the past, because it's just skyrocketed, or actually the opposite of that, I guess, tanked.
Well, and then the other way to be competitive, to compete against that house down the street or whoever you're also up against is with move-in costs and concessions, right? And so that's what these apartments are really good at, right? They'll give you 1-2 months for you sometimes. I mean, if they have to, when they're grand opening, right? They'll do that kind of stuff. But if you can help somebody move in so that it costs them a lot less to move in, that's a huge weight off their shoulders. And that's a big way to compete with.
Because both parties need to wrap their head around the math on that, right? So say your average, maybe you're in a saturated market and there's like a 45-day average days on market, right? So your property's probably going to sit for 45 days before a tenant moves in. It's a month and a half. If we're talking about a $1,200 rental, if you go down on price $100 and we go down on price $100 and get someone in there day one, then you're not losing a month and a half of rent. Well, a month and a half of rent at $1,200 is what, $1,800 that you didn't collect? Well, $100 less over the year, is $1,200 that you knocked off. So
yeah, I'd say the math is even more than that, because when I try to tell people,
utilities, holding costs, all that stuff.
Right. And we talk about the cost of vacancy all the time, and the cost of vacancy on that house you just described is probably $150 to $200 a day.
And then on the tenant side, they get that, you say it's a month rent concession, that gives them more of an ability to spend their money on their moving costs and more affordable to move in. So obviously that's not what investors want to hear, but it's anything in investing is a math game, right?
Yep.
Play the dynamics, play the market. So
get it down, be competitive, get that thing filled up. When you're in a saturated market, that's the most important thing, is get somebody in there. And I'm not saying just put just anybody in there. That don't hear that.
I've seen there's market saturation that can be caused by other things, not only market dynamics. A common one I've seen is changes like events that can change a market, or a sub-market.
Yeah.
So we talk a lot about Airbnbs. I've seen insane market saturation in this
opportunity zones.
Well, I'll get into that, but for example,
is another one.
An HOA with half the unit, if 25% of the units in an HOA, or let's use an actual example, if 40% of the units in an HOA are rentals, and the HOA bans rentals down to 20%, what are you doing to your market? What are you doing to your own values? You're killing them.
It sounds like you've had that happen.
It's currently happening in a few complexes I can name, but you just told 20% of everyone in your complex that they got to sell. Now, whether the board members are, knowledgeable enough to know that that's what they just voted, but it is. What do you think they're going to do? What do you think a bunch of investors are going to do if they can no longer rent? Move into it? No, they're going to sell it. And they're all going to flood the market at the exact same time, which is going to kill the price. And that's what happens.
And that's called market saturation.
That's market saturation. That's a sub-market example. So let's take the other end. We've seen some opportunity zones where people flood into an all-start building at the same time. So take in an investment area to take advantage of a high rental demand and a low supply. Well, if all of those things get finished all after, say you had a demand of 70 and 50 available homes, right? And then 300 people decide to go build homes to meet that demand. Now you're just way oversaturated when they all come on the market at the same time. So
what's an opportunity zone, Kyle?
What's an opportunity zone?
I know that's a whole nother podcast, but nutshell it for me.
I don't really want to, because I don't want to get it wrong. It's a tax thing.
It's a tax thing. No, it's a zone that the government has put aside to encourage people to buy in for whatever reason they need people to come in and buy in that area for whatever reason. Economically, they felt like an influx of buyers into that area will help.
I'm pretty sure it's capital gains free for the first 5 years, something like that.
They encourage that building or that people to come in with capital gains tax breaks. So
investors love not paying capital gains.
Absolutely. So we've personally seen opportunity zones saturate a market over the matter of a couple years.
Yep, and then short-term rental market. We've seen saturation a ton of times. It can ebb and flow. That's probably the quickest moving needle I see with market saturation is you can get the short-term rental Airbnb market saturated. Well, when it gets saturated, people find out quick, and it starts costing them money quick, and then they, you lose the ones that can't make it through, and it kind of works itself out. That's how all markets work. It's just some move quicker than others. We saw, for example, huge market saturation in the short-term rental market after 2022 partially because of the pandemic, because you had a healthy short-term rental market. You lost like half that market when COVID hit. So the market that remained was making a killing, and then prices were just going insane because there wasn't enough Airbnbs for everyone wanting to stay, because the demand for Airbnbs was also insane because there was people stuck in this country or stuck in your state or in your city or whatever. So then again, it became a TikTok trend essentially, and everybody wanted to open an Airbnb, right? And then 2022, now we're still getting through a market saturation phase where revenues are lower than they should be because of that market dynamic. So, which is then knocking people out, and then they're realizing it's not making as much money, and it'll even out again. So,
what did you just say?
That's what I said.
You are absolutely right, Kyle. So it ebb and flows with short-term rentals, ebb and flows constantly, and for all of those reasons and more. And the social media trends are hilarious because they will come out in full force on social media when things are going good. And people listen to that and go, oh my gosh, this guy I follow, this gal I follow, they're doing this and they're doing that, and they're making all this money. And then they talk about going out and doing it. Well, by the time they implement it, it's months down the road and we've got a completely different market. And usually everybody's implementing it all at one time. And then, like you said, once they figure out it's no good, then they've got to go sell it. And then, so it's kind of a cycle. And then,
well, when you see, and it's all conceptual, right? But we've always said, if you see market saturation, like, you don't want to enter the market at that point. That shouldn't be your goal.
It's the number one thing we look at when somebody asks us if we will manage one of their short-term rentals, right?
Oh,
yes. The number one thing we look at is this market saturated? And should you open this or not? We say no to people way more than we say yes. Like, way more than we say yes.
Well, because, some markets are just insanely saturated. I mean, like, you can see the data. I mean, and short-term rentals ironically have very real-time data available that you can see. And when you have, if you're looking at a sub-market and you got 30 listings with, an occupancy rate of 10% or something insane, then that tells you that, like, there's not even enough demand to fill the listings that exist. So why add another one,
It's only going to affect your rate, your rate and your revenue anyways. So.
Well, that's why we always talk about worst case. We've never, as investors, we never consider a deal without looking at all markets. If we're going to buy something to be a short-term rental, it needs to also work as a long-term rental, and it also needs to work as a exit. It needs to be able to be resold without losing money, right? If all those three boxes don't check, because we understand all three markets can change, and in the time it takes to do real estate transactions and flips or whatever, things can change, right? And you want to make sure that if one changes, that you have a backup and a backup.
And that is the real point. I think that's the conclusion of this, really, is there's cycles, right? Mm-hmm. Everything's got a cycle. And the cycles are a heck of a lot shorter than people think and realize. Our emotions and our human brains feel like, while we're thinking on our way to work every day about how much money we're losing or not making on an investment deal or whatever, day after day after day after day, we feel like we're losing our butt, right? But in reality, over the big picture, when you look back on it, it was like 4 months, maybe 6 months, maybe a year. I mean, You know what I mean? It's like investment is a long game deal. And if you are so stressed out about it that you are going to, affect your health and everything over a long-term deal, then maybe in real estate investing isn't right for you. But really, that's the real answer. But,
well, depending on the market saturation could be the strategy. What we just described can be, there's more than just, some people want to start buying when the because it depends on the goal, right? So, like, if you're in market saturation, it could be a bottom, right? You could be getting things at cheaper prices, and then as those things get bought up and everything, and market saturation goes away, now the price is just higher just from buying at a bottom, right? The stock market's a better example, I would say, of a real-time market that moves, ebbs and flows with saturation. But even in the stock market, you can see clearly that when there's a market saturation of money, when the economy has way too much money on the sidelines, sitting on the sidelines, the stock market goes up. This is like a historical guarantee almost. If you track it back, when there's money sitting on the sidelines, it pumps into the stock market. That's why when COVID happened and all these companies stopped making money and their stock prices skyrocketed, everyone's like, what's going on? Well, you have money saturation. It's a market dynamic. That's what happens. So.
Well, okay, so that's saturation. I like your strategy. Let's get back to a real estate strategy. As a real estate investor,
did I just propose a strategy?
Yeah, you did. You proposed a strategy, and the strategy was, and then let's wrap it up. When everyone else is, like Warren Buffett says, do with the opposite of what everyone else is doing, right?
No, when Warren Buffett says, what you're trying to say is when people are fearful, be greedy. When they're greedy, be fearful. And market saturation scares the crap out of people, doesn't it?
Okay, I didn't know that we were going to go word for word, but that's fine. That's exactly
You're
what
gonna
he
quote
said.
somebody
I guess
generally? No,
I just all I was saying was that was his intent, and what he means is do the opposite of what everyone else is doing. So when everyone else right now is a good time because rentals. Talking about the rental market, if it's saturated in your market, then chances are it's a good time to buy. Chances are that sellers are having a hard time selling their homes. And it's a great time to go buy. Why? Because people are not buying for the very reason that we've been talking about, because there's saturation. Saturation is not the most ideal environment for an investor to be in. But if you can understand how to work within market saturation, it's a great time to go out, get some deals, buy, deal with the market saturation, and eventually the market saturation is going to go away and you're going to have the opposite problem.
Well, you play the market. So take it back to, we're talking about different markets. So if the purchase market's saturated and prices are going down and the rental market's not, this is just an example, then buy at a low price, long-term rent it. And then when the market saturation over here in the purchase gets back to normal rates, then ideally your property's worth more and then you can sell it. So that's a strategy that is commonly used. I mean, what happened in 08? What would you call that?
The values just plummeted.
Why?
Because nobody was buying anymore. Everyone stopped buying because nobody
everybody
could
was
buy.
foreclosing, and they were flooding the market.
You lost your demand instantaneously. Lost demand,
and you got a lot of supply out of it too. So,
and bid foreclosures created a whole bunch of supply. Yep.
So that was a market saturation.
It was a market saturation. So, and that was a great time to be buying. That's what I'm saying. In hindsight, there were some people that were snatching up homes for dirt cheap prices back then. And man, I bet everyone wished that they had done that now, right? It was a fantastic little 2 or 3 year run to just be buying and snatching up homes that you'd be sitting on right now with so much equity. It's crazy. So, but very few, even the smart ones, very few people were doing it, and that's why you gotta understand how these cycles work and just run with it. Look, you can manage market saturation no matter what it is going on. You just have to understand that you have to be competitive on price, maybe give some concessions. You got to do what you can to attract people to your home. Make sure that it looks nice. Make sure that the condition is good, that it has some curb appeal. Like, don't put a junker out there when the market's saturated that is obvious to everybody it's a junker and expect to just get somebody to come rent it like you used to maybe be able to do.
What did we used to say back in 21? You could rent a box. You could throw a cardboard box out there and rent it.
There was a period of time where I feel like you could have rented anything.
Yeah.
I could have rented backseat of my car while I was driving around in it. But...
well, Tesla's going to make sure you can do that here soon anyway.
Yeah, they are.
You just won't be driving.
Different podcast.
Different podcast. So, I mean, what do we do with this? What? I'm an investor. What do I do with this? Well, are investors buying right now?
Well, they should. No, they're not, but they should be. And that's the point. Is they should
smart
be,
investors are.
Yes. Buy. Now is a good time to buy. Deal with the market saturation and make sure you deal with it in a smart way so that you don't have vacancy time, high vacancies, and then you're going to come out of that come out of that looking so smart.
Yeah, because what can we expect? I mean, we've talked a lot about the high end market dynamics, but if we're in a market saturation and we got interest rates that, I'm not going to say where they go from here, but what they go to, but they're going to go down before they go up. Right? That's everything we've heard out of the Federal Reserve.
That's what everyone thinks, yes.
No, I'm just going based off what these guys keep saying. And a $3 trillion spending bill may hit in a month. So,
yeah, it's going to be great.
What happened last time a $3 trillion spending bill hit?
Fantastic.
Your home price went up. Why? Market dynamics.
Inflation.
No, market dynamics. M2 money supply, baby. You increase it, assets go up. There's your strategy. Just kidding. This is not financial advice.
Yeah, I don't know.
We are not financial advisors. But we are investors.
There's also a dilution of the dollar that happens and all that good stuff. So, but anyways, that's not why we're here. We're talking about market saturation.
Dollar directly increases asset prices.
What's our strategy for market saturation? be competitive.
Buy high, sell low.
Buy low. Buy now, be competitive to get through it. And I wouldn't be scared of it. It's just a cycle.
Well, let's talk about like the real quick, like cap rates. What is the return investors are expecting low returns right now, which means you can get things at lower prices.
Really?
Mm-hmm.
So it used to be everyone wanted 8 to 12% cap rate, right? That had to be what
Well, when interest rates were 0 to 3, yeah.
What are we seeing now? What are people expecting in a cap rate?
It's more like 6.
Are we now going to have to do a
lower,
podcast on cap rates now and explain what they are?
Probably need to do that, you know? Capitalization rate. How much do you want to make off your capital? Do you want to make 8% or do you want to make 6?
Next week, Kyle's going to do a podcast on cap rates. I'm not going to be here. I might be here. I might be sitting right here if I'm in presence, but I'm not going to be part of it.
He may buy a deal based on cap rate before the end of the week, but he's not going to understand it, huh?
Yeah, well, I know you're going to get into the fundamentals and the formulas. So, but seriously, what kind of cap rates are you seeing out there right now that people are looking for? Like investors are saying, I want to see this amount. Well, I know it's not 8 to 12% anymore.
No, it's not. No, they're saying that for sure. The ones actually making moves are not getting that. At this level, I would say. So yeah, like 6. 6 is a good cap rate right now. Just is what it is. When interest rates are high, the cap rate expected goes down.
Yeah.
But when interest rates go down, people will start expecting a higher cap rate. In the commercial industry, that can directly affect what you sell a property that has no change for.
Don't take all our content for next week's.
All right. Well, John wants to beat this one a little bit hard. I'm just kidding. If you guys have any questions about market saturation, give us a call. 817-818-9039. You want to start buying some stuff, send us an email at showmethemoney@wearetpm.com, and we are out.
We go.